Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for July 2018. Let's take a look at key highlights of June. US President Donald Trump met with North Korean leader Kim Jong-un in a historic summit in Singapore and signed an agreement to work towards complete denuclearization and lasting peace regime on the Korean peninsula. The US Fed hiked the benchmark rates by 25 basis points in its policy review as the economic growth continues to rise at a solid rate. The Fed's dot plot suggests a likely total of 4 hikes this year versus 3 hikes earlier. The trade deficit in May widened to a 4-month high of $14.6 billion, up $1 billion versus April as imports picked up 15% year-on-year, while labor-intensive exports remained muted. The current account deficit in Q4 financial year 18 stood at 1.9% of GDP. We expect CAD to widen to 2.5% in financial year 19 in the wake of higher oil prices versus 1.9% in financial year 18. The Indian rupee fell to a lifetime low of 69.09 during the month due to a host of factors like strengthening dollar, higher crude prices, wider current account deficit, and foreign portfolio outflows. The Indian currency has declined by over 8% in the year 2018. Market remained range-bound during the month in the absence of any major triggers. The market breadth has been weakening since February, and the gap between mid-cap and large-cap is rising. The number of companies hitting fresh 52-week lows continue to rise. Mid-caps continue to face selling pressure, and this trend may likely continue. In the large-cap space, few heavyweights like HDFC Twins, HUL, TCS, and RIL are holding the market tight. The benchmark index may see some short-term volatility, even though the long-term growth levers remain intact. We maintain a Nifty target of 11,500 for June 2019. Index of Industrial Production for April 2018 rose modestly to 4.9% versus 4.6% in March, owing to a low base. The rebound in Index of Industrial Production to 7 to 8% early this year is now moderating towards a still healthy 5% level. EPS estimates for Nifty Index for financial year 19, financial year 20 and financial year 21 are Indian rupees 594, Indian rupees 712 and Indian rupees 776 respectively. As per blended estimates, Index is currently trading at PE of approximately 17.1 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. Clients having high exposure to mid and small cap via direct equities may look at trimming their positions and moving to large caps or managed solutions. The 10-year benchmark GSEC is hovering in the range of 7.77% to 7.99% on a semi-annualized basis. The bond yields remain elevated on account of rising inflation, weakening rupee, volatility in international crude prices, and global trade war fears. The RBI Monetary Policy Committee unanimously voted for a 25 basis points rate hike at the June policy review, citing concerns over rising inflationary pressures, particularly core inflation. This was the first rate hike in 4 years, even though the committee maintained a neutral stance. The RBI has conducted only one open market operations purchase this year in mid-May and with no follow-on purchase for more than a month. The RBI may have to conduct a few more open market operations to assure investors of its support. Headline CPI accelerated to 4.87% in May 18 versus 4.58% seen in April 18, led by an upsurge in perishables and fuel in addition to an unfavorable base. Inflation excluding food and fuel components accelerated at a quicker pace, touching a 45-month high of 6.3% in May 18. We expect benchmark yields to remain volatile and trade in the range of 7.60% to 8.00% with an upward bias of 25 basis points. Yield movement hereon will depend on inflation trajectory, supply-demand dynamics, crude oil prices, and global bond yield movement. We expect the MPC to maintain status quo in the August policy review. We recommend investors to allocate 100% of their fresh fixed income allocation to long-dated buy and hold strategies and active accrual strategies with low to medium duration.